All right, let's dive right into one of the most massive economic debates going on today and really unpack exactly what the data is telling us about the future of artificial intelligence. In this explainer, we're going to break down the sheer scale of the AI boom, look at the cold, hard numbers, and try to figure out if we're standing on the edge of a monumental technological shift or a pretty devastating market cliff.
I mean, this really is the trillion-dollar question on everyone's minds right now, isn't it? And I don't just mean tech enthusiasts on social media. We're talking about everyday investors, massive Wall Street banks, and even central banks like the Bank of England and the IMF. The sheer scale of excitement and, honestly, the creeping panic in these institutional halls is totally palpable. They're looking at the jaw-dropping amounts of money pouring into AI, assessing the systemic risk this poses to global markets, and asking, is this sustainable or is it a bubble that's about to violently pop? To get to the bottom of this, here's our roadmap for today. Number 1, what is an AI bubble? Number 2, the red warning signs. Number 3, the 4 O's framework. Number 4, dot-com crash flashbacks. Number 5, boom versus bust. And finally, number 6, how it all ends. Let's get right to it. Starting with section 1, what is an AI bubble? The gap between hype and reality. So, look. The absolutely crucial point here is that a bubble is defined by a massive, unsustainable gap between the hype driving the initial investment and the actual real-world value being generated on the back end. We're looking specifically at how current market mechanics are detaching from current utility. When valuations skyrocket based purely on future promises rather than present-day cash flow, well, you create a pretty precarious environment. Today, we really have to ask if the artificial intelligence sector has stretched that gap way past its breaking point. Because the sheer scale of investment we're talking about here is just staggering. By 2026, projected global AI spending is expected to hit $2.5 trillion. To put that into perspective, that represents a massive 44% jump over the previous year. Capital is just flooding into the hardware, the software, and the talent of this sector at a pace that is completely unprecedented in modern economic history. But here's where the alarm bells really start ringing. When you put the spending right next to the actual returns, you can vividly see this terrifying gap that has so many economists totally spooked. We're seeing reports of one major AI company investing $150 billion while only projecting $15 billion in revenue. I mean, that's a 10-to-1 ratio of spending to earning. It immediately begs the question, how long can you spend $10 just to make one before the music finally stops? Which brings us to section 2, the red warning signs. 8 indicators flashing danger. You know, one of the most fascinating and maybe concerning things happening right now is this little piece of industry jargon called circular funding. This reveals how some current valuations might actually be built on a highly fragile house of cards. Instead of outside money validating a company's worth, you have tech giants essentially just shuffling capital between each other. Company A invests heavily in Company B, then Company B turns around and uses that exact same money to buy cloud computing services from Company A. Suddenly, both companies look incredibly valuable and highly profitable on paper, but no actual new economic value has been created. Tech analysts have put together this comprehensive list of 8 distinct warning signs that suggest the AI landscape is facing some severe structural bottlenecks. We just touched on unsustainable investments and circular funding, but the physical limits are arguably even more pressing. Power and energy shortages are becoming a massive ceiling. You literally cannot build data centers faster than the electrical grid can support them. When you compound that with geopolitical risks, like those escalating tensions over chip supply chains in Taiwan, you hit a hard physical roadblock to limitless software growth. Add in consumer dissatisfaction over AI tools hallucinating or just failing to deliver on their grand promises, and you've got a perfect storm of vulnerabilities. Moving right along to section 3, the 4 O's framework, Ruchir Sharma's economic checklist. To synthesize all these warning signs, renowned economist Ruchir Sharma has this brilliant mental model. He warns that the AI boom is currently flashing red on all 4 of these critical metrics. First, we have overinvestment, with spending surging at a pace rarely seen in modern markets. Then, overvaluation, with major AI players trading at extreme price-to-sales ratios, which, historically, almost always precedes severe market corrections. Third is over-ownership, where retail investors have a record share of their wealth tied up in just a handful of AI-related equities. And finally, and perhaps most crucially, we have over-leverage. For years, big tech companies were famous for sitting on massive hoards of cash. Today,
They are issuing enormous amounts of debt just to fund this relentless AI arms race, drastically increasing their vulnerability if interest rates stay high.
So, Section 4, .com crash flashbacks, comparing 1999 to 2026.
With all these alarms ringing, it's completely natural to look back at the devastating dot-com crash of the late 90s for a comparison. However, the bullish experts point out a massive, fundamental difference here. Back in the dot-com era, companies had almost zero revenue. They were built entirely on promises and hype. Today's tech giants are a completely different beast. Companies like Microsoft, Alphabet, Meta, and Amazon are largely funding their data center expansions out of their own existing massive cash flows. And they're making real money today. Nvidia alone reported over $81 billion in revenue in a single quarter. That stark contrast between tens of billions in actual profit today versus the empty promises of 1999 is the absolute bedrock of the optimistic argument.
Furthermore, if you look at the broader market, the S&P 500's forward price-to-earnings ratio is sitting at just 21 right now. That's really only slightly above its 5-year average of 18.5. This tells us that while specific niche AI companies might be priced sky high, the broader stock market isn't nearly as wildly overvalued as it was during the peak of the dot-com bubble. For the everyday index fund investor, this means the overall market actually has a structural cushion it simply didn't possess 25 years ago. All right, Section 5. Boom versus bust, the great debate. This slide perfectly categorizes the heavy institutional weight on both sides of the argument right now, and it shows just how divided the financial world is on our immediate future. On the bearish side, you've got heavyweight thinkers like Ray Dalio, alongside the Bank of England and the IMF, actively warning that unproven business models combined with rate sensitivity are a recipe for disaster. But on the other side of the aisle, bullish banking titans like Goldman Sachs and JP Morgan are arguing that the underlying growth is fundamentally justified by the very real, tangible revenue these technologies are already producing. Some of the more prominent voices on the bearish side view this current market stability as deeply deceptive, warning that the underlying metrics are completely unsustainable. They actually call this a toxic calm before the crash. Oof, that's a heavy phrase. Their core argument is that the cheap capital that fueled the initial AI surge is highly vulnerable. If inflation persists and central banks are forced to keep interest rates high, the cost of borrowing becomes exorbitant. That chokes off the cheap capital for highly leveraged tech companies, leaving them incredibly exposed and poised for a rapid, nasty contraction. Conversely, though, thought leaders at institutions like MIT Sloan present a much more optimistic scenario, a healthy course correction. They call this the soft landing. In this environment, we avoid a catastrophic market crash entirely. Instead, the inflated hype just slowly deflates. Companies shift their focus from building flashy, expensive demos to generating actual return on investment. The weak, purely hype-driven projects naturally die off, and the genuinely durable, useful applications of AI survive, thrive, and integrate seamlessly into the global economy. Finally, Section 6. How it all ends. Triggers and domino effects. So what's actually going to decide who's right here? Honestly, you might want to take a screenshot of this slide because these are the exact concrete triggers you need to be watching in the coming months. Watch the U.S. Federal Reserve. If they raise interest rates, the era of easy debt for AI expansion ends immediately. Watch the Q2 through Q4 2026 earnings reports. If these massive AI companies miss their revenue marks, institutional investors will panic. Keep a very close eye on hardware and chip supply constraints. Watch if actual AI revenue continues to lag behind these massive capital expenditures, and absolutely monitor any US-EU trade tensions that could disrupt essential global supply chains. These are the specific needles that could easily pop the bubble. And look, if a burst is triggered by those factors, the shockwaves are going to blast way past just tech stocks. Analysts project that cryptocurrency, which often moves right in tandem with high-risk tech turbulence, would take a direct hit, potentially dragging Bitcoin heavily downward into the $60,000 to $75,000 range. Beyond that, a major tech correction would severely throttle venture capital. When VC funding dries up, innovation bottlenecks. Thousands of startups are forced to shutter, and the damage quickly bleeds into the broader job market, halting hiring and shaking overall consumer confidence to its absolute core. So, based on everything we've explored in this explainer today, from the terrifying gaps between spending and revenues to the incredible real-world profits actually being generated right now, you now have the tools and the metrics to watch the markets for yourself. As the data rolls in through 2026, keep your eyes on those key triggers. What do you think? Are we truly headed for a devastating market crash that mirrors the late 90s?
Or are we simply flying through a patch of turbulence on our way to a healthy, revolutionary soft landing? Keep watching those numbers, because the answer is absolutely going to reshape the global economy.